Welcome to the second part of the lecture for Chapter 12. So in this part, we'll talk about how to deal with partners withdrawing, how to deal with ending the partnership, which is a little bit complicated, and then I'll go over the statement of partner equity. So there's two ways, similar to the way that there's two ways a partner could buy in. They could either buy an interest outside of the partnership directly from an existing partner, or they could contribute assets to the partnership. Withdrawing is the same way. It could happen two ways. So either the existing partners personally could buy out the departing partner. In that case, we just swap out the capital accounts like we showed before, increase some capital accounts and decrease or wipe out the capital account of the person leaving. We would also reestablish asset values before we did that so that they would accrue to the corrective partners before they leave. Or the partnership itself could buy out the departing partner. In that case, we would also revalue assets, adjust capital accounts, and then buy them out so that they get benefits of any increase or get the pain of any decrease of assets during their ownership. When we pay them out, the departing capital account is debited to clear it out, and we credit cash. Now the partnership, if they don't have cash on hand, they may need to sell some assets to generate cash or borrow money to generate the cash necessary for that transaction. Again, the partnership agreement should provide the details for how all of that happens, and that's why it's important to talk about that up front and document it so that there's no disagreement later when someone wants to leave. So the process of liquidating a partnership is also called winding up, and there's 4 steps in that. The first step is we sell all of the assets of the corporation. That's called realization. Now that's going to generate either a gain or loss in most cases, so we allocate the gain or loss from that transaction based on the income sharing ratio like we showed in the first part of the lecture. So again, if there's no provision for that, then the gains and losses are shared equally. We then take the cash that is generated by selling those assets and we pay all of the liabilities. So we satisfy all the obligations that the partnership has. That will leave us with a balance sheet that just has remaining cash and the owner's equity balances, which should of course balance. So then we distribute that cash to the partners, and based on their capital account balances, not based on income sharing ratios. And then that should create a balance sheet that has all zeros across it. So I'll go through that in detail. So when assets are sold, any gains and losses are distributed according to the income sharing agreement. I just mentioned that. If that allocation, say there are losses allocated because it's a fire sale and we're taking whatever we can get for our assets, that may create a loss, and it could cause a capital deficit in one of the partners' accounts. Maybe a particular partner has taken out quite a bit of their capital balance over the years, and so they have a capital balance of say $5,000, and we allocate a $10,000 loss to that partner. They have a deficit then. So one of two things could happen there. Either they could bring that to zero by bringing in a contribution, or we wipe out that deficit and allocate it to the remaining partners based on an income sharing agreement. So effectively spread the pain of that person's deficit over the existing partners. So all debts are paid. So in this case here, you can see balances before realization. The chart on the bottom there, we had cash of 11,000, assets of 64, liability of 9,000, and then we had 3 different capital balances. So we sold the 64,000 in assets for 72,000. So we had a gain in that case. So we increased cash by 72,000. We wipe out the non-cash assets, and then we distribute that gain that occurred by allocating that according to the 50%, 30%, 20% of those 3 partners. So now we have a cash balance of 83,000. We have liabilities of 9, and then we have the 3 owners, the 3 partners' capital accounts. The next step there is to pay the liabilities. So we pay out the $9,000. So cash goes down by 9,000. The liabilities are wiped out. That has no effect on the partner's capital accounts. So now we've got 74,000 in cash, and we have 26,000, 24,400, and 23,600, which equals 74,000. So now we write checks to those three partners in those amounts. That wipes out the cash balance. Ending cash is 0. Ending non-cash assets are 0. Ending liabilities are 0. And now that we've paid them out, all of the partners' capital accounts are at 0. So that's what it should look like at the very end. So here it is in journal entry form. So step 1 is selling the assets and recognizing a gain. So we debit cash, credit whichever assets we have sold, and record a gain on realization. Of course, that may happen in multiple different transactions. At step 1 might be 6 different transactions that all accomplish that same thing if we sell assets at different points. And then we take that gain on realization of $8,000 and we allocate it to the partners' accounts. Again, that's done based on their income sharing scheme, whatever that is. Third entry then is debiting whatever liabilities we have and crediting cash to pay the liabilities. And then step 4 is to pay out the remaining cash to the owners and debit each of their capital accounts. Pretty straightforward. Now let's take a look at an example where there is a loss on the sale of the assets. So the beginning line there, balances before realization, that's exactly the same, okay? But in this case here, we're selling $64,000 in assets for $10,000. So we have a pretty substantial loss there. So we basically had a yard sale and didn't get much. So in that case, I've got a $54,000 loss that I've allocated to those partner accounts based on their percentages that they take for income and losses. You can see that that then gave us a deficit balance for Farley. So we have $21,000, we pay out the $9,000 in cash. So in this case, Farley comes to the table and says, oh, I can see I have a deficit. Here's a check for $5,000 to bring my capital account to 0. So now the company has a little more cash. Farley's capital balance is at 0, so now I can take the $17,000 and I can pay out the amount to Green and Hall. So that's a scenario where the partner with a deficit brings cash to the table to correct that deficit. So the way that looks in terms of journal entries is we sell those assets at a loss. So we get $10,000 in cash for $64,000 in assets. So we have a debit, loss on realization. We allocate that debit balance to the partners. We pay our liabilities. And here's where that one partner, Jean Farley, brings $5,000 cash to the partnership to bring her balance to 0. And then we pay out the total cash to the remaining 2 partners. And again, that brings all their balances to 0. So the last thing I want to show you is the statement of partnership equity. And this is very much like a statement of owner's equity that you studied in Accounting 201, where it's just a recap of the owner's claim to the business. So what is their beginning balances, what increased it, what decreased it, what's the ending balance. So in this case here, it's just expanded where in a sole proprietorship, we would just have one owner and just one set of numbers. In a partnership, we'll have multiple columns for different partners. So we can see what happened with each partner. So you can see here, Dan Cross had an opening balance of $245,000 in his capital account. Kelly Baker had $365,000 in her capital account. Dan made a $50,000 investment in the partnership, and Kelly did not make an investment in the partnership. Their net income for the year was split $40,000 and $80,000, so that both increased their capital accounts. And again, that came about through closing the temporary accounts and allocating the income to the capital accounts based on their formula. And then we have ownership withdrawal or partner withdrawals, so money that the partners took out of the business for their personal compensation or whatever they needed. So that gives us the ending balance. So it just provides an overview for somebody to look and say, what happened with regard to these partners' claims on the business over the course of the year. So hopefully you found that helpful. If you have any questions while you're working through the homework, remember that you can check on, you can go through and do a practice assignment. Now in Cengage, you need to click on all assignments rather than just assignments that are due. So that'll help you see the partnership assignments. And if you have questions about that, shoot me, or excuse me, that'll allow you to see the practice assignments. If you have questions about that, shoot me an email. Thanks a lot. I look forward to talking to you when I lecture on corporations in Chapter 13. Thank you.